Everyone says buy low, sell high. Yet history shows millions of investors do the exact opposite. They buy when markets feel safe and exciting, then sell when prices collapse. Why does intelligent, rational people make this costly mistake? And how can we train ourselves to stop repeating it?
That's one of the greatest paradoxes in investing. The stock market isn't just a marketplace for buying businesses. It's a stage where human psychology plays out every single day. When markets are rising, optimism spreads like wildfire. News headlines celebrate new highs, friends brag about profits, and suddenly investing feels easy. But when markets fall, fear becomes contagious. The same assets that looked attractive yesterday suddenly feel dangerous, even if nothing fundamental has changed. Our brains evolved to survive immediate threats, not market volatility. When we see our portfolio dropping every day, our survival instincts take over. Selling feels like escaping danger, even though that emotional decision often locks in losses.
So the biggest enemy isn't the market, it's our own mind?
Exactly. Behavioral finance calls this loss aversion. Research shows the pain of losing money is psychologically much stronger than the pleasure of making the same amount. Losing 10% hurts far more than gaining 10% feels good. That's why panic selling feels emotionally satisfying in the moment. Then comes herd mentality. During market crashes, everyone seems to be selling. News channels amplify fear, social media predicts financial disaster. Watching thousands of people panic convinces us they must know something we don't. But history repeatedly shows that the crowd often becomes most fearful near market bottoms. Think about the major market crashes over the decades. Investors who sold at the lowest points often missed the strongest recoveries. Meanwhile, disciplined investors who stayed invested or even bought more were rewarded over the long term. This reminds me of Warren Buffett's famous idea: be fearful when others are greedy and greedy when others are fearful. It sounds simple, but emotionally, it's one of the hardest things anyone can do. Another hidden trap is recency bias. When markets fall for weeks or months, we begin to believe they'll keep falling forever. Our brains mistake recent events for permanent reality. Yet markets have always moved in cycles. Fear eventually fades, businesses adapt, economies recover, and patient investors benefit from time. The investors who build lasting wealth aren't necessarily the smartest. They're often the ones who develop emotional resilience. They create a plan before emotions arrive, diversify wisely, invest consistently, and refuse to let headlines dictate their decisions. At the end of the day, successful investing is less about predicting tomorrow's market and more about managing today's emotions. When you learn to master fear, you stop reacting like the crowd and start thinking like an owner. That's where long-term wealth is built.
A powerful reminder that mastering your emotions may be more valuable than mastering the market itself. If you enjoyed this conversation, like, subscribe, share your thoughts below, and join us next time for another deep dive into the psychology of investing.